Are you looking to buy a home and trying to decide between an FHA and conventional loan? Well, that's exactly the question we got today from Chris B. Chris asked the question, what's the difference between FHA and conventional home loans, and which one is better for me? Now, if you have a question, you can submit it on our YouTube channel in the comments, on our Facebook page, Instagram, or on our website at lendingahand.com, and we will get back to you as quickly as possible with a video just like this. My name is Scott Wynn. I'm with the Wynn & Egan team at Citywide Home Loans. I work jointly with my wife, Marla Wynn, and our business partner, Joe Egan. So let's compare FHA and conventional financing. So the first thing I'd like to point out is, what does FHA stand for? So FHA is the Federal Housing Administration. They offer primary residence or owner-occupied financing only, meaning in order to get an FHA loan, you must plan to live in the home that you are purchasing. Conventional financing, on the other hand, sets their rules through two entities, Fannie Mae and Freddie Mac, and they allow financing on owner-occupied properties, second or vacation homes, and rental or investment properties. So that's one big distinction, that if you are looking to purchase either a vacation home or a rental property, you must utilize conventional financing, as FHA does not allow that. Another big distinction between FHA and conventional is the down payment requirements. Now with FHA, the minimum down payment is 3.5%. You can obviously put more money down, however, the minimum is just 3.5%. Conventional financing requires a 5% minimum down payment unless you meet certain circumstances. There's two exceptions to the 5% minimum down. The first is if somebody on the loan is a first-time home buyer, and according to mortgage rules, a first-time home buyer is somebody who has not owned a home in the most recent 3 years. So if you haven't owned a home in the most recent 3 years, you're considered a first-time home buyer. If at least one person on the mortgage is a first-time home buyer, then you can qualify for a 3% down conventional loan option. Another option is income restricted requirements related to conventional loans may also allow you to qualify for a 3% down payment on a conventional loan. Another distinction between FHA and conventional is credit. Now, FHA does allow for, according to the rules, as low as a 500 credit score. However, the down payment requirement does go up if you go below a 580 credit score. But the problem is that most lenders don't go below a 580 credit score anyway, so it doesn't much matter. So keep that in mind, that with FHA, although the minimum credit score is 500, most lenders are going to require at least a 580 credit score. Conventional financing has a minimum credit score of 620. We'll talk a little bit later about how you're rewarded for higher credit scores using conventional financing, and that'll come into play in making your decision between which loan program, FHA or conventional, is going to be better for you. So in addition to the credit score, you also must meet credit requirements. Now with FHA, the credit requirements are going to be a bit more lenient than they are with conventional financing. With FHA, for example, with a Chapter 7 bankruptcy, after a Chapter 7 bankruptcy has been discharged, you must wait at least 2 years before you can get financing using FHA financing. If you are in the midst of a Chapter 13 bankruptcy, as long as we can document 1 full year of on-time payments through the courts, and they provide approval to enter into a mortgage, we can do it after just that 1 year. With FHA, foreclosures in the past, you must document at least 3 years have passed since the public trustee's deed was recorded, meaning after the government has completed their full foreclosure process and the recording is completed, then 3 years from that recording date is the date you can enter into a new FHA loan. Conventional requirements are a bit longer. For a Chapter 7 bankruptcy, you must wait 4 years. Chapter 13 bankruptcy, 2 years. And if you've had multiple bankruptcies in the most recent 5 years, you must document at least 5 years since the most recent bankruptcy. Foreclosures are going to require at least a 7-year waiting period since the time that the foreclosure was recorded. So you can see there are a big additional time requirements on conventional in comparison to FHA. Mortgage insurance, another big difference between FHA and conventional. So with FHA, there are 2 forms of mortgage insurance, both of which are required. The first is a 1.75% upfront mortgage insurance premium, sometimes referred to as UFMIP, and that is financed into the loan. So it does not require you to come out of pocket with that. However, it is an additional cost that gets added onto your loan. In addition to the upfront mortgage insurance premium, you also have your monthly mortgage insurance premium in the amount of 0.85%. That is an annual amount divided by 12, and that's how you determine what the monthly mortgage insurance calculation would be. If you are looking at more money down with FHA or potentially shorter terms, such as like a 15-year term, the cost of mortgage insurance may go down a little bit. Another thing to point out is that with a minimum down 30-year fixed FHA loan, the monthly mortgage insurance sticks with that loan for its entire term. For the entire life of that loan, you must pay mortgage insurance no matter how much your home is worth, no matter how much you've paid down. Now, again, that can vary a little bit depending upon more down payment or shorter terms. So that is something to consider as well. With conventional financing, if you have 20% down, you can avoid mortgage insurance completely. And with monthly mortgage insurance, it's not as straightforward like it is with FHA. If you get an FHA loan, you automatically are approved basically with the approval on your FHA loan for the mortgage insurance. Conventional mortgage insurance is private mortgage insurance, sometimes referred to as PMI versus FHA's mortgage insurance premium or MIP. So because it's private mortgage insurance, it's basically a separate insurance policy that gets tied to the mortgage, and there are different rules and requirements that must be met to get approval for mortgage insurance. Now, in today's day, basically the rules to get a conventional mortgage are right in line with the rules to get mortgage insurance on that conventional loan. However, that's not always the case. Sometimes that can be a little bit different. Sometimes higher credit score requirements may be required in order to get mortgage insurance. But again, as of this video in 2020, you are generally able to get mortgage insurance as long as you can get approved for the conventional loan. Now, the amount of the monthly mortgage insurance on a conventional loan is going to vary based off of your credit, as well as the down payment, the term of the mortgage, meaning 30 years and 15 years and so on. The nice benefit of conventional mortgage insurance is that it will eventually drop off. It drops off generally after you've paid it for a minimum of 2 years and after your balance hits 78% of the value at the time of closing. So that's a benefit of conventional mortgage insurance in comparison to FHA mortgage insurance. There are some different ways to avoid monthly mortgage insurance with conventional loans. One way is through what's called lender-paid mortgage insurance. I won't go into detail on this, but it is something I wanted to point out, so it's something you could inquire about as you go through the process of potentially getting a conventional loan and looking at the different options related to mortgage insurance. FHA loan limits do vary by county. That's going to be a little bit different than how conventional works. So the link to the loan limits will be provided to you in the detail and description, but here's the link as well. You can just also do a quick Google search for FHA loan limits, find the one that's offered by HUD with that link there, hud.gov, and enter the state, the county, and it'll show you what the loan limits are. Loan limits are going to be offered based off of the number of units that are being purchased. So most people are looking at a single unit property, a single family home, townhome, condo, something like that. However, FHA financing, as well as conventional, allows you to purchase multi-unit properties like a duplex, triplex, up to 4 units for a fourplex. And there are higher loan limits allowable per county for FHA financing. Conventional financing, however, has national loan limits. Those can be found also by just searching Google for conventional loan limits and looking for the website at FHFA.gov. Again, you may not necessarily need to pull that. However, there are some high-cost areas and may be worthwhile looking it up just to see what the loan limit is in the area that you're looking and planning to make a home purchase in. So it comes down to the question of which one is better, right? FHA or conventional financing? Well, FHA is ultimately going to be the better option if you have lower credit scores, if you're looking for a loan shortly after, let's say, a bankruptcy or foreclosure, where you don't necessarily meet the time requirements that conventional has. Or if you are looking for less down and don't meet the requirements of being a first-time home buyer or in the lower income. Conventional, on the other hand, is going to be better for those with higher credit, more money down, or if you're looking to purchase an investment property or a second home. So if you look at these two loans, really consider those circumstances, those situations, because conventional financing, even though you can go down to a 620 credit score, may have mortgage insurance that is so much more expensive that you would be better off going with an FHA mortgage and getting the 0.85% mortgage insurance at a lower cost than you could with the private mortgage insurance through conventional. So that's really where the major distinction comes. So again, if you have, let's say, a credit score of 700 or 720 and above, and you're looking at a down payment of 5% or above, conventional financing is probably going to be the path for you. If you're looking at financing for less than 5% down, or you have a credit score under, let's say, 700, then FHA may be an option to investigate as well. So hopefully that answers your question. If you have any questions, certainly let us know. And if you'd like to submit a question of your own, where we can record a video just like this, please visit us on our YouTube channel and make a comment, or our Facebook, Instagram accounts, or our website at lendingahan.com. Thanks for watching.